Cool. Well, welcome everybody. This session will be on the future of commerce, trends shaping tomorrow's market. For this one, we're going to try to make it a bit more interactive, a bit more fun. So if you guys have any questions kind of throughout the panel, feel free to just raise your hand and we'll take them as they come in. It's a very interesting topic here, and we have Nate joining us. I'll let Nate give his intro. Yeah.
Hey everybody, my name is Nate Moyer. I co-head the Disruptive Commerce and Internet practice within the innovation economy at JP Morgan. It's a pleasure to be here.
Absolutely. Amazing to have you here. I guess to really get started, from your perspective, what does disruptive commerce mean, or how would you define that?
This is like you're starting with the hard questions first. I was actually polling a few people out there to see how they would define it. But the irony is that it's hard to define, but you know it when you see it, is kind of what I say. And I think that's always challenging when you run a group that you don't really know the true definition. So we did come up with one, and that is generally institutionally backed high-growth consumer firms. And if you think about like subsectors, that would be pet, food, bev, beauty, wellness, and we do some retail too, in addition to some lifestyle and fitness. So anything you're eating, drinking, feeding your pet, or visiting in sort of a high-growth retail type format. We created the category because what we were seeing from our clients at JP Morgan is that this set, again, sort of loosely defined, had very specific needs that was a little bit different than, like, let's say the average company growing at 3% GDP. So they required faster products and services that a bank like JP Morgan can offer. They needed advice and they needed it quick because they were scaling so fast. We try to think of things of like helping companies look around the corner. And what we found is that it needed a specialized group of people, so we stood up a group to address that. Okay. And so again, it's like, I can't give you like the definition of like 25% growth rate or only addressing the VMS channel, but you know it when you see it.
Yeah, that makes a ton of sense, honestly. Honestly, the world that we live in right now is so, it changes so fast, right? Things are always evolving, things are always changing. What would you say are like some of these macro forces that are being applied today, and like what are really the biggest changes that it's driving?
The macro, in my opinion, is like a really, really interesting topic. And if you look at that 10,000 foot level data, it tells a particular picture. I mean, I think we might argue that that's not exactly reality. And what I mean by that is that at the macro, you're looking at this pressured consumer. I mean, you've got unemployment. We're seeing, at JP Morgan, we have a lot of data, so we see like card balances are higher, deposits are lower. You see it in the consumer sentiment survey, and it's trending down. But the reality is like people are spending, and that's what's like so interesting. And so like we ask the question, well, who are these people? And what you find is that the 10% of income earners are spending 50% of the spend, or they account for 50% of the spend, and that the bottom 60% account for 20%. And so like think about that like bifurcation, and it's just so interesting when you're a consumer business and you're trying to target your ideal customer. I always think about it as like you're kind of looking at these two segments, and it's like, well, who is that person in the 10% that speaks to your brand or your product? And how are you going to target them in the best way possible? Because they're the ones spending all the money. The rest of that spend is spread out across, 90% of everybody else. And I think the question is, how do you get to them? And you're looking at a lot of those spenders, and they're young. They're generations younger than us, generations younger than millennials. And they're using the next phases of commerce. And that how and who is going to be really, really important to target those folks for the brands that we work with, and a lot of the brands in the room.
Yeah, I feel like with that, there's a couple different strategies that people can kind of deploy. Like people have multiple sub-brands which target like different geographic or wealth kind of segments, right? They'll do ones that are more high-end brands. Like I guess what other strategies or ways of approaching that problem do you see that are quite effective?
Yeah, I mean this is the heart of it all. Like this is a tough, it's really understanding that customer. And I think like, when you're a company and you're looking at your band of, let's say it's like 10 different customer profiles, it's like, what is that message for each one? And I know that throughout this conversation and others that people are having that I heard here is like, AI is going to be a part of that. Because brands have to think through those questions that you posed and really find a way to hone in on that. These are, generally small brands, scrappy, maybe raise some institutional capital, but that's earmarked for particular things. Like, how are you going to address those 10 customer segments without utilizing some piece of technology to make it most efficient and get that best message out to the right people?
Yeah. Kind of going off of that, it goes in like these consumer expectations and how you kind of even, target your brand towards these individuals, right? How do you think through that? Like, how do you understand what these consumer expectations are and how they're evolving over time?
They're evolving quickly, and they'll probably continue to evolve. I'd say, in my opinion, that the expectations of customers are as high as they've ever been, and I think part of that is that they're quite informed. There is a wealth of data out there that people can go obtain and form an opinion around. I think I have like a personal, belief, if that's what you want to call it, that I think they think they're more informed than they really are. And they're picking up on information that either they don't have the full understanding or they don't quite understand what they're gathering. From an expectation standpoint, I think product, you're still looking at sort of these macro trends that have carried over, the last, let's just call it decade of health and wellness, the better for you, a lot of the plant-based things. People want health. They want it to be functional. They want to see where it's coming from. They want it ethically sourced. And I think from a platform side, you have to meet these customers where they are, and that means mobile, online. You have to provide an elevated experience. And I think customers today, you have to transact in a sound, safe, efficient, and in some cases global manner. If you're looking at, I always use examples of this, but just last week we had a company file and another company go public. One was Once Upon a Farm, which I think is a super interesting story. So you just talk about sustainability and ethically sourced. This company has over 100 or just under 100 co-mans where you can read about what they're doing, what the product is. And this is a non-discretionary, purchase for these folks like children. They need to read that label and they need to see where this product is coming from and who's manufacturing it and who's developing it, where the inputs are coming from. There was another point, and this is all public, by the way, these points, because it's from their S1, but talk about meeting the customer where they're at. Once Upon a Farm, 40% of their sales come from a click, and for a CPG brand, for those out there, that's super high. And they make a point in this one to talk about the competitive set, and the competitive set's at 10%. So they're 4x more efficient in getting that customer to spend. So and if you think about that from the DTC kind of landscape, you're getting all that data about your customer, you're smarter about, you can target the next product to them. And then from the retailer side, if it's that clicks going through their rails, that's more efficient and more cost effective for the retailer. Yeah. So they're liking that too. So when you talk about expectations and how companies are solving them, I thought that was a really good example of one, and it's benefiting them and it's allowing that company to differentiate themselves and address the equity capital markets in this case, and raise significant capital from institutional investors.
Yeah, wow. That's an amazing example. I actually was just looking at that company, filing their S1, which is absolutely insane. I don't think we've seen a CPG company go public in quite some time.
It's amazing, and they've got the growth story, and what makes it even more amazing, and I'm probably going to butcher the number, so I won't say it exactly, but they're not profitable. And so you just said, what's the last CPG company that went public? And I might answer, yeah, maybe there's one or two, but what's the last one that went public that's not profitable?
Yeah,
and that's
fair.
Really interesting.
Yeah, I guess with all these trends and all of this information that's constantly coming out, how do you kind of keep on top of all these trends personally, and then what would be your recommendation for others to kind of stay on top of this and remove all of the random noise from what's actually real?
I'm laughing. I just turned 45, so me keeping up with the trends personally is about as funny as it's going to get. We do have a wealth of data at JP Morgan. It's a little bit of the embarrassment of riches. For a Chase card perspective, we're in one of every two households from a Chase card perspective. We process merchant card transactions at all the retailers that you guys know. Starbucks is a good example of that. So like every card you scan in a store, we see that data. We actually run the wallet for them, so we're seeing the ins and outs of that flow, which I think is pretty interesting. If you guys are JP Morgan clients or prospective clients and have a relationship with us, you have access to a platform called Morgan Markets, and that's our equity analyst portal, so you can learn a lot there. So again, there's so much, but to get to your question about the like kind of sifting through the noise, because that's a lot, right? And it is at kind of that 10,000 foot level. You know, we use a lot of anecdotal evidence. Like we have 1,200 clients in my Disruptive Commerce and Internet business. So we look at that data that I described earlier, and then we kind of kick the tires with real life examples of the clients. And so we can either learn it anecdotally if we're evaluating a new, let's call it a credit ask, or we might call them up, or we might do a panel like this and learn something. And I think that that's so important. And this is a dated story, but I think that it's worth telling. And do you guys remember like the Better For You ice cream craze? That's what everybody talked about. Halo, I wasn't going to use any names, but we have Arctic Zero, Light, and Halo, and then some of the strategic brands. But think about the energy. I'm picking on you now because you said it. We're going open forum here. But think about all the energy that poured into that space, and the capital and the interest and the retailer interest, clearing out shelf space and everything. And the reality is that the product kind of, or I should say the marketing beat out the product in that case. Again, I'm trying to be really sensitive because they're real businesses, and they didn't command an aggregate across those companies like a multi-billion-dollar valuation. Yeah. And it was just multi-hundreds, which is fine. It's better than I'll ever do. But it's just such an interesting story because when we were looking at all that, we tasted the product. And every time someone came back and was like, I don't know, I think I'm still going to reach for the Ben & Jerry's because I'd rather have the third. Is that your?
Yeah, I love Ben & Jerry's.
Okay, what's your favorite? I'm flipping the script. What's the favorite flavor?
Oh, man, milk and cookies.
There we go.
Yeah.
Okay, mine's mint chocolate chip. But, right, it just wasn't the category that everybody thought. And I thought it was so interesting because every single data point pointed to that it was going to be the next, Microsoft. And, it wasn't because repeat purchases just didn't happen. And okay, so you can eat a pint of ice cream. That actually sounds amazing for the cookies and cream thing. But 280 calories, 4 grams sugar, whatever, or 10 grams protein, I don't know. It just wasn't enough. So anyway, thanks for the story, guys. That's just an example of that, of sifting through all that data. And you just really have to kick the tires. And in consumer, you have to talk to the customer.
Yeah, makes a ton of sense. I feel like in this world that we live in, where the information just readily available at all times, you kind of have to take that step back and look for the anecdotal data. And almost always when there's this mismatch from anecdotal data to just the raw data, totally. Anecdotal is almost always correct. And that's kind of where you have to lean towards.
Totally.
At least that's what I've seen in my experience. But
I think that's where the consumer is wrong. And there's all this information, but I think that maybe not all wrong, but part wrong. And if you look at, and I'm going to, again, botch the data, but it's something you'd rather give a negative comment than a positive one. And then I go read reviews of high-growth CPG businesses, and 99% of them are positive. And I'm like, well, this doesn't match this, this data that everyone says is you lead with the negative. So I think it's just interesting when you're looking at the data.
Yeah, absolutely. I guess shifting more to the investment side and the investment landscape in general, how would you say the investor priorities have shifted in disruptive commerce over the past couple of years?
Yeah, I'd probably take the couple years and multiply it by 2 and just go a few years before COVID.
Sure, yeah.
And actually Hannah and I were talking about this earlier, but oh yeah, there she is. I'll probably have her come up and show me up here pretty soon here. But the investment dollars that poured into there came from early stage investors VCs, which were non-traditional sort of CPG investors, and saw an angle with tech, which was using online tools and using data to build a real business and capture a cheaper customer, which ultimately didn't pan out. And it seemed like every incremental customer became more expensive, and then Apple changed the policies that kind of messed that up as well. And so if you look at it again, back to the ice cream example, I'm not trying to like talk bad about any of these. They're all great companies. It's just the valuation expectations were off. But if you look at that aggregate valuation from peak to now, I'd say that if you pulled out any given company, it's down 70% to maybe even 95% if you're looking at something like the alternative protein companies. And so investors today, I think, have gone back to like a back to basics model. And that profit or the growth at all costs is now turned to like you must be profitable. It used to be 24 months. I'd now argue it's probably 12 to 18 months in which you have to have like a clear visibility into that. I'd say that investors, and we'll just go /strategics, are looking at deals that are now probably 100 million plus, so triple-digit million plus, maybe even 200 depending on the business model. Whereas before, like we would get a lot of interest from like on my platform from like 25 to $50 million in revenue. I don't think you see that as much anymore, and people really need a proven concept. And just like we're kicking the tires around the data, like they're really kicking the tires around these potential acquisition targets. I think if you can touch on what the customer wants, and you've checked the boxes that I've sort of laid out, like the financial KPIs and like scale KPIs, I think the question that those investors will ask is like, will these businesses, despite checking all these boxes, be able to capture like the new methods of commerce that we are seeing and that we will see? That's to me, that's like the next question.
That's interesting. Do you think there is like this first mover advantage then, like for these new trends that are kind of happening and being shaped and all this kind of stuff? Does that first mover advantage kind of still exist in the CPG, food and beverage kind of side, or is that not really a thing and people are it's kind of the second, third, fourth, fifth people that are learning from these mistakes and the market's actually shaping more over time and you kind of really want to see this form before you're making these investments, or is this like not really a reality anymore?
Yeah, I mean, that's a really good question and probably like answered with anecdotes. So where it's working is like David, right? So, top in or best in class, like sugar to protein ratio, they just bought their IP, right? So like if you've got the barriers to entry figured out and you've created your own moat, first mover, like I'm all in. As we know with CPG, like building that moat is difficult.
Yeah.
And so being the first person out of the gate and like having everybody learn from their mistakes or raise the most capital or hit the shelves as fast as possible and probably spread out too thin, I think could be difficult. And so I would be very, very cautious about that.
Makes sense. Okay. Which segments would you say like D2C, marketplaces, all this kind of stuff are like especially hot right now?
I mean, they're all hot. I don't know if there's any like heads nodding, but I think they're all growing at a double-digit CAGR estimated over the next 9 to 10 years. I think you just, despite the fact that like a marketplaces or I'm sure like social commerce or B2B2C is like what you're referring to, these are double-digit CAGRs with high expectations and hundreds of millions of dollars of pouring into that. If you just look at the big three, TikTok Shop, Walmart.com, Amazon, I mean, they're investing hundreds of millions of dollars. Amazon doesn't break out their figures completely, but like if you triangulate enough, like, I mean, you're talking about over $300 billion of transaction value, gross merchandise value in 2024, because they haven't published 25 number. I mean, it's just amazing. I wouldn't sleep on DTC because the whole purpose of that, even though the VCs kind of got it wrong a handful of years ago, is that you own that customer and you own that journey from, when that customer interacts with your brand, through the purchase journey, through everything. And data is so valuable that if you lose it out to the marketplaces or you just go, social commerce, like you're not there all the way.
Yeah.
And that's going to have an implication.
Makes sense. Yeah, I mean, I don't think we could have this conversation without talking about AI. So
I knew it. I knew it was coming. I warned you guys.
So how would you say like AI is kind of reshaping this space?
Super hot topic. Obviously, like there's so many different facets. Like given that this is like more of a disruptive commerce, like CPG in nature, there's a handful of, I guess, facets of AI that I think one are super interesting and two that I think we should all strive to understand or at least improve on if we're doing it already, because I think it's the game changer. One of those is just, it's the content AI. And so like AI-driven content I think is so interesting. And I think we talked about it before, like different customer profiles. I think the winner in that space is if you can get the best message to your customer by doing it efficiently, and AI is great at that. And so if you can get the one message out about your brand or your value proposition and can multiply that, and you know your customer, which is another part of it, I think you're gonna be in a really, really good spot. I think this predictive analytics is really interesting too, and there's a lot of talk about that. I think this actually may be the furthest of a handful of the like more CPG-driven categories. But how many times for like those in the audience or just anecdotally, like is the hero SKU like out of stock when you're going to the web page and it's like your favorite product or the product that you just heard about and you go and it's like, and I always think it's like interesting when they're like 4 times sold out. And you're just like, geez, like, didn't you like guys learn on the second or third time to like make more? And then you flip it and then you're like, when is the non-hero SKU like in stock?
Yep.
And if you're in retail and you discount it because you're a growing company and working capital matters, like, what does that mean for your brand? And now you've like lost your top line. You've positioned your brand in a way that was not intended, that one might argue negative or neutral at best. And I don't know. So I think that those tools will be huge. So that's really like where I think we should be focused on. And then if you add another, I guess it's like the hyper-personalization at scale, where, and this is targeting, you got the best message out, now this is to your message to your best customer. And if you can figure out like who you need to go to and make that experience is like what we talked about with like this is what the customer is expecting now, and this like evolved customer, they've got everything else, free shipping, free this, like It comes fast, it comes immediate. You're just really gonna have to hone in that message to that person, and it's just gonna be critical. I mean, and you can succeed without it, but like I think you have to think of things in like whether it's a vacuum or in like a super competitive dynamics in an industry that carries little moat outside of marketing.
Yeah.
Like you're not just like in a vacuum competing. Like you're competing against everyone else. So if everybody else starts getting good at this, like it's gonna be a problem. I think it's just a matter of what we were talking about upstairs, which I thought was like really interesting. Like what can you take on? It's like if it's 1 step back for 2 steps forward, like yeah, that's a great trade. Until like you're doing 3 things at once and it's 3 steps back and you're a small company and you're like, okay, well, how am I gonna dig out of this? And then it might be too late.
Yeah. Yeah, it's honestly very interesting because there's like this whole phenomenon where you're talking about something or just thinking about something and somehow it pops up on like Instagram or Facebook and you just get an advertisement there.
Yeah.
And it's clearly just very, very good targeting. And like some companies have this just like super, super dialed in.
We do like a pipeline, sorry to interrupt, like we do a pipeline review and my Instagram's like, every client that we work with. I'm like, you guys need to pay me more. I'm like broke trying all my clients' products. Like after this portfolio review, I can't even help myself. Sorry.
Yeah, I mean, honestly, some people do such a good job where I'm like, I don't know. I feel like I'm pretty difficult to convince. There's like a lot of things where I'm like, I don't need to try things. I don't need to try this new stuff, whatever. But it just keeps popping up like the exact right time. I'm like, damn, I kind of want to get it now. It's like it's really, really interesting that like if you just keep hitting them over and over again and kind of at the right time with different messages, one of them is bound to land. Because like I've seen like this one gummy, it's called Create. It's like a creatine gummy. And I'm not even working out that much right now, but somehow they've framed it.
I wouldn't have guessed.
Yeah, somehow they framed it as if this is just like a daily creatine thing you should just take and it's good for your health. But that was just one of the touch points out of like maybe 20.
Yeah.
And that was enough to be like, oh, maybe I should just take it every day. Why not, right? Like, that's great.
I'm like strong until the 5th time. And then I'm like, let's just do it.
Yeah, yeah.
But you guys I get to flip the script too, right? Because you were going to go out to the audience, so I get to ask you questions too. What, like, at DOS, like, this is something that you guys are considering all the time and already doing so. Like, what's your take on it?
Yeah, with AI, honestly, our take is that you really need a strong foundation, right? there's AI you can kind of tack on top of random other systems, and it will give you some sort of lift and be kind of helpful, and it's more like cool and like a party trick than anything else. And then there's like actual systems that are built for AI and built with AI in mind, and those systems can truly transform the way you work, and that's effectively what we've gone and done at DOS. We've laid this really solid foundation, and when you implement it into companies, it allows you to actually have transformational change across the entire org, and more of this will come out over time as we develop it, but it's going to be pretty crazy in the future, in the coming year, where we develop a lot of really, really cool AI, things where actual like jobs are getting augmented in the sense of like they don't have to do a lot of really manual stuff that they should not be doing, and they'll get a lot of really cool insights from a lot of data, and the data is actually clean, and it's going to be really cool to see once you've laid a really solid foundation. So I think that's probably like the most important thing is having a solid foundation, clean master data, all of this kind of stuff. If you can set it up well, then you can utilize AI more effectively.
Yeah. I saw the Walmart CEO, I think it was last week, said that AI will change every job in their organization. At a company like that, I mean, that's a pretty impactful statement.
Yeah.
And you read past the headline, and they're training their employees to basically work differently. And my takeaway from that was that it will change actually like the business model and like the paradigm in which like that business operates, including like people and how they work on a day-to-day basis. And I think from a DOS perspective, it's like earlier stage startup, younger people, adaptable, which is, I'm sure, a benefit, and you guys feel that and can stay ahead of the trend. But I do, CPG, historically is it's a legacy industry, and we're competing against legacy players. It'll be really interesting to see how the overall industry reacts. I'm less worried about disruptive commerce specifically because of the nature of our loose definition. But it's just such an impactful comment where I was like, wow, this is actually, he's just acknowledging a full like paradigm shift.
Yep.
It's not like, oh, we're going to launch a marketplace. It's like he's basically just saying the entire Walmart will be changed.
Yeah. Yeah, it's really interesting, honestly. And like perfect segue into the next question. So how would you say like these incumbents are adapting, or maybe they're not, to all these disruptors that are popping up?
Yeah. I mean, it'd be interesting to hear if anybody has any other anecdotal experience, but I think the incumbents, or let's just call it like, entrenched strategics, and I'm just thinking about like kind of CPG, like retail right now, has historically found it pretty difficult. My gut is that it will continue to be difficult because being authentic as part of your brand is so important, and more important than ever, I might argue, and that seems like the one hurdle that they can't just get over. I mean, yeah. I think we all know like they've got the resources. I mean, they've got the cash, they've got the people, they've got the rails, they've got the supplier and like distribution network. I mean, they've checked every box, but they somehow can't cross the chasm of releasing a product where everybody is, fervently excited about. So I think it will continue to be difficult. I just think that what we're seeing, and we talked a little bit about it upstairs, is like it's not going to be the it's the sub sort of 100 or sub $50 million businesses. Like it's just that you need to prove more now, and then they'll go after you, and then you just saw that with like the Pepsi Poppy deal, Lesser Evil Hershey. I mean, it's all happening. Celsius, like there are deals getting done, and if you look at those brands, I mean, they stand for something. They actually all fall under the umbrella of sort of the better for you or function or both, and so they've rode that wave, which is a powerful one, and all those businesses were scaled too. Very, again, like it's not the $50 million brand these days.
There's like this mass consolidation in food and beverage, right? Like these massive companies, Mars, Hershey's, whatever, Pepsi, just buy up all the incumbents, right? When they reach a certain percentage market share. Do you think like that's just going to become the norm? They're going to kind of keep going down, or is this like? Do you think CPG brands or food and beverage brands can fight this and still go public, like a Celsius or something like that?
Yeah, like Once Upon a Farm. I still think it'll be few and far between. Like, those strategics carry so much value, and again, like the rails and the people and just the synergies that they bring to it all. I think it'll be a future that will continue to exist, and it probably will look a lot like today. Yeah, I mean that's kind of my take on it. I just like like further consolidation, I think, is just going to be really tough, and I think that those behemoths count on us collectively to deliver the next, X, and whether that's standalone, which would be amazing if it can be. I mean, the public markets have been treated these companies, I shouldn't say unfair, but they've really cut them down to size, and so if you're the CPG brand, I don't even know how willing you are to go test it. And so that's kind of another question too. And it's just a tough road out there on a quarterly basis. So I guess it might change from quarterly to, but right? Like it's a tough road out there. I mean, there's a lot that you have to address.
Yep. I guess going back to like the founder, disruptor kind of side, like what are some of these like common scaling mistakes that you see some operators make, and what advice would you kind of give them to get them on the right track maybe, or some pitfalls you've seen?
Yeah. I'll leave out like the specific pitfalls, but they're like categorically, I think that it's that step function scaling issue, and you'll see it at other stages. This is just my kind of take, but or it's a good way to think about it, like 0 to 20, 20 to 50, 50 to 100, and like let's just call it 100 plus. And we talked about like a paradigm shift. I feel like those are like mini paradigm shifts within a company, where it might be your management team, your operations team, it might be your partners, synergistic partners that are helping build your brand. The founder that can take the company from 0 to 20 is not likely the founder that's going to build this business to the 100 plus and like the once upon a farm like public story. And we talk a lot about that. And after the happy hour, during the happy hour, I'd love to hear you guys' thoughts, but loaning $100 million to a business that doesn't have the right finance team, but super passionate entrepreneurs, is like, that's not like the JP Morgan game. Bringing in a strategic, despite the fact that they have all these expertise, to invest in a brand that's not run in a professional way to their standards, and there's like operating it and then to their standards. And it's real, and we see it a lot. And so it's also hard to make that break. So who's telling that founder, hey, let's find you a role as a president? And that conversation I've seen get pretty tricky. So I think that's one thing to just look out for, whether you're on like the investor side or sort of the partnership side from lending or operational capabilities, is we think about that a lot, and it comes up a lot. From a risk perspective, and we were chatting about this not long ago, but think about the last 5 years that we've all had to deal with COVID, and this really affected CPG brands too, but COVID, just recently the tariffs, geopolitical concerns. I mean, it's like mind-boggling what people have been through. And I'm borrowing this saying, but risk is what's left when you've thought of everything, and inherently disruptive commerce are risky businesses. So when you've thought of everything, you've come up with your plan to address COVID, which no one did. You've already come up with your plan to address tariffs, which few people did, in my experience from our portfolio. And so you look at this world of risk that's just there if you've done everything right and address the new risks that come up, and then look at the new risks that have come up. And these are like showstoppers. Tariffs, full showstopper. And this is not advice. This is just what's happening. I wish I had advice. But you just have to think through that. And even a big business like JP Morgan, 20,000 people, and global business, largest bank, we basically cut 20% of plan and see how we react to that, and stress test the 4-letter word out of the business. And we're hearing that from our leaders down, and I just think that that's a very appropriate way to go, especially if you think that the past could be our future, which was a lot of turmoil.
Well, that perfectly.
Geez, was that super positive?
Yeah, it was. That was great.
But like as zero, like it says zero, as I'm like, we're all dead.
Well, I mean, it goes perfectly to the next question, which hopefully isn't equally as grim. I guess like looking 5 years out, right? This is really like the I guess $1 billion question, right? 5 years out, what does disruptive commerce look like to you?
We got to define it first, right? Like, yeah, we're going to need everybody's help on that. I think one thing that I like think about, which would be exciting, and again, like maybe we're all too old to think through it, but like I'm just convinced that things are going to like jump off the page a little more and be like less two-dimensional. And I'm not really sure what that means, but like if we're headed towards this new models of commerce and people are doing things differently and it's people half our age that are doing them, I just can't see a world where we're still like whipping flat things out of our pockets and like doing transacting. Yeah. And so like again, like for me, it's hard to fathom like the AR kind of goggles, and I know that like Apple's launch like didn't go that well, but like fast forward 5 years, like who knows? Like I think about 5 years, like I didn't have a kid 5 years ago. COVID didn't happen. 2 months ago, this is kind of crazy now that we're opening up, but I had spine surgery. 2 months ago, I didn't know that I needed that, and I didn't live in Park City 2 months ago. I lived in LA. So like that's 2 months. Like 5 years is going to be crazy, but I do think that things will. It just seems a little two-dimensional based on the audience that is now transacting and engaging with brands. And maybe we need everybody's help to imagine what that non-two-dimensional world is, but I think it'll look and feel, and we'll interact with things just a little bit differently than today.
Yeah, when I think about that, I see like WALL-E. Like all the scenes from WALL-E where people are just floating around on the stairs and there's like this screen in front of you. Yeah, it's scary stuff. Okay, cool.
We ended it on a bad note again.
No, it's all good. It's all good. That's way far in the future.
Okay, good.
Let's say 50 years, yeah.
Because none of those people could walk, right? It's terrible.
Yeah, everybody take creatine gummies. You guys will be just fine. Don't worry about it.
Yeah.
All right, we'll open up some questions. Does anybody have any questions for Nate?
If you just look at sort of the investment alone in it, which is like sort of the numbers that are easier for us to track, and then on the anecdotal side, those are a little harder because they're newer models and we haven't engaged with them fully. But if you look at on the capital side and look at just some of the estimates that like the McKinseys of the world are putting out with like, I think it's like mid 20% CAGRs like for 10 years. And you look at a pattern IPO, 40% growth, $1 billion plus revenue, sole purpose, engaging brands and making it easier for companies to do that and transact. I'm not sure I see another world where like those don't play a meaningful role in the everyday consumer's experience. I'm just not quite sure if it's like tomorrow or a year from now. Yeah, from a financial KPI perspective, I mean, definitely depends on like the segment where like beauty's gonna. I mean, we focus a lot on gross margin too, and like, I know I gave my intro and I probably didn't give it complete now that you're asking this question. So we are lenders, so we do look at things a little bit differently than our equity side. We do early stage loans, just have like an equity link component and like compete with like sort of an SVB if that's the easiest way to like think through it. But gross margins like mean a lot to us, and I know you didn't mention that. And like, if you think about that as like how a company scales, like I mean, it's critically important, right? Because like all of a sudden, if you're scaled enough and you've created enough of a customer base, and it depends on your accounting too. But if you can kick out that marketing function, then you see like the true sort of operating rhythms of that business, and like that's going to be really important to the strategics too. And so like usually that's like one of the first questions. And so a lot of people can chase growth, which is another like financial metric, which I know you didn't bring up, but that's at the expense of another like, which I think is like a more critical one. For the LLM question, I'm not sure. I don't know yet. Again, like we're seeing things kind of on the lending side in that realm, like similar to the other question, and just a little bit later. What I am curious about is if we do have a plan to address how to target customers, like will it change? And I think people thought through that through, the traditional like CAC and then Apple like shifts it, and the next day it's changed. And so whatever my answer is, I'd probably have an asterisk next to it and be like, beware of what's around the corner on that one before you like, plow everything as an investor into, the next model. I mean, really good question, and we get it a lot, and so we do work with earlier stage brands, and in a little breakout session above, and we just talked about like some of the venture loans, like we do work with pre-revenue companies. They have like very specific reasons why we're working with them, whether it's like an investor that we're exceptionally close with, or they've raised a large enough amount of capital where risk is kind of like negated, right? Because they have sitting on $50 million of liquidity, and you're like, well, I can lend you $5 million. Yeah, exactly. Yeah. Which we have a handful of those. But what I would tell a brand that is either like not eligible at that level or commanding that level of attention through their influencers or followers is to have like a tightened up ship and like know what you're asking for, know how much. That's a tricky one because like you're like, well, I don't want to dilute myself, but then like you got to pay interest and principal at some point, and that starts to add up. I mean, that's like you go sideways on that, and that's kind of losing the company. JP Morgan, we're a global regulated bank, as everybody knows. We are playing at, I would say, on the like sort of risk scale outside of that venture component. Like we're playing on the lower risk side. There are a handful of players that generally we'll make an introduction to or suggest and be like, hey, these guys are really good at that $5 to $10 million segment in this space. Generally, we stay pretty close to them, so we know that they bank the next VMS company that's similar, has a similar business model. But we're always like down. It's so casual. We're always down to like give advice to folks and be like, and I'm a big fan of like art of the possible. And so like if you're a $20 million brand and in your head you're a $50 million brand tomorrow, which is what you show on paper, like we can do some pretty interesting math and describe like what it's like to work with us if that's what I don't even know if aspire, if that's what you plan to do. And there's plenty of other really great capital solutions, and some of those are equity, and some of those are debt, and some of those are non-bank debt. And it's not a one-size-fits-all, and we are more than happy and willing to help people along that journey because it builds goodwill for us, and we're generally just interested in learning about the business and the founders. If I'm thinking about it correctly, we're actually making some adjustments to that because so many of our companies now work with Amazon. And so you're sort of bending the traditional way of like leveraging AR and inventory and like margining that to get some sort of availability, and utilizing some of that Amazon inventory, which is basically going like this with like no AR. And so we can see that through data, which is interesting, and come to a conclusion where this inventory is turning super fast. Amazon may or may not own it. We feel pretty confident that it will be gone if they don't replace it because it's a great product and a great brand and great people running it. And so I will say that our model is changing because of these new sort of commerce models. I think I fear, I guess, but like a consideration that I would have is like that took us some time. People have been selling Amazon for a while, and we're now just starting to like dip our toe and like being a little bit more creative. If you guys all know how fast all this stuff is going, if like Amazon and the other, Walmart.com and TikTok, like if we have to look at it differently, I do kind of worry about how fast it'll be till we have a really great view and we're not behind the 8 ball. And I'm sure that there'll be a competitor, much like you see in the fintech space, like doing something really interesting there. So it's a really good question. I think it's up to like us and my team to like stay ahead of that and get really smart and guide our risk partners, the keepers of capital, to make bets where we feel like the risk is appropriate. That's the hardest part, and that was a little bit. That's the easy answer, because I just kicked the can down the road. But I mean, that's what everybody's wrestling with, and so a lot of times what you'll see is like folks will get really honed in on one channel and like prove themselves and like know their customer and know who they are as a brand, and really create an environment where like they've got a plan, they're through. Let's just pick on like retail for an example. You know, again, they know who they are. There's a particular gross margin profile for that. And they might be like, hey, we're ready for that next step because we've scaled enough, or we're going to raise another piece of capital. They could raise that because they proved out their retail presence. I mean, what you've seen over the last, I shouldn't have started with retail. I should have started with DTC because that's the easiest to kind of start on. And if you can build that up enough, build that customer, where now that customer is going into the store and seeing that DTC product that, you know, they were transacting online and now it's on the shelf, brand recognition, displacing other brands. I mean, that's the secret, and it's sort of this like step by step. I think I go back to like, don't take 3 steps back for the 6 steps forward, because 3 steps back is going to kill a brand under 50 million in revenue. It's just too much, and you're going to be chasing. You're not going to know like how to target the right customer online. You're going to miss the like B2B2C, like the sales enable stuff on social. And then on retail, it's too hard to manage all that. Like the retail partners is its own like ecosystem, and I think you're just going to get into trouble. If I heard your question right, I think focus is good, and a lot of the best brands are going to choose one and then head to the next. Yeah, I would say it's more on like the like subsectors, and so like if you're looking at like the top 10% of earners, like generally they're just going to be older. They're going to be like homeowners that have like, you know, got like a 2% interest rate, all the things that we miss, like, you know, and and they've ridden a 13-year bull market with like very little dips. And so they're rich on paper, and, you know, they're willing to spend on travel and leisure, and they're generally older, and so like health and wellness is huge for them, just in different categories of like, it's not necessarily creatine, but it's other sort of like wellness sort of services. I mean, it's a great example. Creatine's like explode. Creatine's it's like hard to get now.
Yeah,
you know,
yeah.
like companies are like whey and creatine's like impossible.
Yeah.
So to answer your question, I would just like so the answer is yes. I would just rephrase it as opposed to like the particular model. Like we've been focusing on like the segment, and then when you go down into that lower wage earners or, you know, total net worth spenders, and again, it's more of like that. How are you going to get in front of that person? I think that's like really interesting, and that's like more of the channel that I think we're focused on. Is like, is it going to be more of that like B2B2C? Is it going to be DTC? Is it going to be marketplaces? And it's probably going to be all of them, to be quite honest. I just think like for the companies that know that it's going to be all, like how are they going to get the help to launch, to do it all?
Yeah.
Like I don't know what company can do it all.
Cool. Well, thank you guys so much.
Thank you.
Yeah. Absolutely. That was fun.
Awesome, guys.